Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for WealthPress. That's what I was last time I checked. It's the 6th of December. Wow. Folks, don't get old. That's all I'm going to say. Time just flies too fast. It's about 7:42 in the morning. The market's going to gear up to open up in about an hour and 38 minutes to be exact with you. And the Dow's up 200. The Dow's up about 20 points. Definitely not up 200 points. The Dow's up about 20 points after having a very, very strong downside corrective pressure where we saw downside of more than 500 points. And I hate to say I told you so, but I told you this market was not stable and was not ready to go higher. And this is the first week institutional traders are back after holidays. A lot of times, institutional traders, they don't go all in heavy during holiday weeks because, as me, they know that the market is fragmented. There's not a lot of participants. And the trading action we see during holidays typically isn't directionally sustainable. This is something you should pay attention to. So whenever there's a holiday week and you see the market really moving one way or the other, you should be very, very skeptical that that move is not a sustainable move. Now, we've got international trades in goods and services today. We've got petroleum report tomorrow, and then we've got the PPI on Friday, which is the big report, consumer sentiment, which I'd love to see consumer sentiment right here, but it's going to be after. But it's going to be before the PPI, which is going to be the CPI, which is going to be the following week. But right now, the Fed is set as priced in on the bond market to raise rates half a basis points. I'll talk about all of that, but I need you to pay very, very close attention to the bond market because the bond market right now, it looks like it's huffing and puffing, but look at these overbought levels. They're very serious, and it looks to me like the bond market is topping out in the near term, aside from being overbought. If you go back here, you'll see that typically when it moves to and bond markets are pretty good reversion to the mean markets. They're not that trending. They're pretty efficient. So you could see here, anytime we start getting up here, the bond market tends to cool off. And right now, it looks like we're going to go right back into the base, much like I believe what we're going to see with the stock market, which, dropped 471 points yesterday, $1.37%. It's now down 0.12, up 0.12%. But what I'm looking for the Dow is, I'm looking for the Dow to drop below the 33,686 level, which is, or thereabouts, which is the support level right now. We're at 34,000. So we're not talking about very far. We're talking about 400 points, which is just a day or two. And I think this rally will correct itself and we'll start seeing selling pressure move down back to the base. Let me show you market internals so you could see that it's already happening. Now, I don't know if you remember or not, but this was at 90th percentile. And the Dow was at 95th percentile about a week ago. And I explained to you that these are not sustainable levels. They're not going to hang out here. And we're going to start seeing this start moving more red, purple, whatever you want to call it, but it's not going to be dark green. And as you will see right now, it's already happening. Look at that momentum level. Remember I said it's like an elephant turning around? Well, this was us throwing peanuts at the elephant and getting its attention. Now that elephant is looking at us and it's ready to turn around and go back. But as you'll see here by momentum levels, we're only 99 stocks to the downside making 20-day lows and 33 stocks making 20-day highs. This number will go up to about 500, 450, 600, between 450 and 650 before we bottom out. So we're just getting started. We're just getting started here. This has to cool off, and I'll show you a different template, but you will understand what I'm saying. This needs to cool off and come back down here or back here because this level is unsustainable. Last time we were up here was in May of 2020 when we were recovering from that COVID downside. So the odds are very, 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 and I'll say it again, very strong that this market is going to subdue lower. Now let's talk a little bit about market briefing and see what you guys have on the table today. AutoZone is reporting today. Very important. Keep your eye on Advanced Auto Parts and keep your eye on what's GPC? GPC. Genuine parts. Sorry, I'm more familiar with the tickers than I am with the names. I've been doing this for a while. But AutoZone is reporting today. Coupa Software is reporting today. Piedmont lithium battery reporting today. That's going to be very, very important. But as you could see here, Dave Buster's Entertainment, Toll Brothers, real estate company, that's a juicy one right there. That's one of the biggest realtors. But overall, earnings season is behind us, and the biggest catalyst is now what the Fed is going to do next. So let's talk a little bit about market participants, and I can clue you in on all of that. Market participants fretted that stronger than anticipated service sector activity could point to the Federal Reserve making stronger, higher interest rates or keeping rates higher longer, not cooling off. Three major indices indices were weighted down, but let me show you what sectors. Oil and gas, they didn't do well. Financials and consumer goods. Consumer goods shouldn't do well at all. I'm not seeing it at all. Tesla tumbled over 6% on reports that Model Y production cut by over 20% and its Shanghai plant, pulling the tech-heavy index down. And remember, Tesla's part of the ARK fund, and the ARK has been very, very choppy. So there may be, there's rumors being denied that the production caught in Shanghai, but again, 20% cut. That's huge, huge, huge. So you got to keep your eye on Tesla next few days. Tesla is a very, very important tech stock. U.S. service activity, which has been an area of economic flagged by the Fed as crucial contributor to inflation, unexpectedly rose to 56.5%. Remember, I said industrial is doing pretty good, stronger than expected, which means indicating signs of underlying momentum. Well, if that's the case, then the Fed can go a little higher on their hikes. They can be a little more aggressive. Remember, good news is bad and bad news is good. It's a very, very strange time we live in. Now, here's where it gets interesting. Remember, this is the as priced into the bond market. There's a 78.2% chance of a 50-point rate hike, and now 21.8. Now, the more the market goes lower, the more you will see this number increase. I wouldn't be surprised if this number got back to 30, up 40% before the next Fed announcement, which I think is 11th or 12th of about a week from now. So 75 point, it's still on the table. Today, we're looking at the U.S. trade balance. That's coming out at about half an hour. They're looking at a balance of about 80 billion compared to previous value of 73. That number is not looking better. China closed slightly higher as more cities lifted anti-COVID measures. China announced that relaxation of more testing mandates in the country's capital following easing of anti-COVID measures in several cities. Also, media reports suggest that Beijing is preparing to withdraw more restrictions. So this is really, really positive for China, and that could help lift Chinese stocks. But folks, that doesn't mean the worst is behind us. It just means that they're not... Think about this. Global economy is really bad aside from COVID. So that's something else China has to grapple with for the next couple of quarters. And in Japan, the index closed higher by gains in retail, mining, and shipbuilders. Very, very, very interesting. Now, volatility, as I mentioned, looks to have bottomed out, and it looks like we're going to start seeing more upside. As I mentioned to you guys, the bond market is overbought right now in the short term, and the bond market looks like it's ready to cool off. Matter of fact, let me just show you my chart here so you could see how overbought it is. And I think bond market's going to come down. It's going to increase yields on interest rates, and that's going to put more pressure on tech stocks. Now, looking at the sectors, as I mentioned, only 99 stocks are making 20-day lows, and 33 stocks are making 20-day highs. Before the bottoms out, this number will move 5 times as much. So we're nowhere near there yet. But looking at individual sectors, which we will do right now, you will see that industrial, healthcare, basic materials, consumer staples is now leading, and energy is now falling down, and so is utilities. Now, I wouldn't write down energies just yet. I would be very, very cautious because I think energies is going to run up again because I'm not seeing the end of this war, and we're still in an inflationary environment. But notice, industrial, healthcare, materials, consumer staples, financials, and energy. These are defensive sectors. I'd like to see utilities move a little higher. Real estate still in the crapper. If you look at this chart, you will see that industrial held off really well. Healthcare held off really well. Basic materials looks like it's doing okay. Consumer staples is rocking and rolling. Technology, I think, will undo most of it, and this will come back down. I think energy is going to come back up. I don't think we're ready to really cool off on energy. Financials is a question mark. Real estate, I think it's going to cool off. Consumer discretionary, I think it's going to cool off. Communication services, I think all of these sectors are going to come down all the way back to their base. And I believe that the S&P 500, let me show you the S&P 500, is going to, which right now happens to be right at the 200-day moving average, is going to cool off. I don't see this. I don't see this continuing. The RSI can't even sustain these levels. There's really no catalyst. And if we break below 397.84, which is yesterday's low, not really that. I mean, we're only up 0.12. We lost almost 2%. We're up almost 0.12. It doesn't look like the market has a lot of upside. Now, unfortunately, my timing was wrong. I told you that the market was going to cool off right here, and actually, let me show you on the Dow. Let me show you where my mistake lies. My mistake was I thought we were going to around here fall off because we were already at the 200-day moving average, but we saw this trading action. Now, this trading action right here happened mostly around the holidays, and it happened because we had some good news on blue chips. But I'm telling you right now, I think the Dow Jones is going to come back down with the rest of the market. If you look at the QQQ never even went up to the 200-day moving average. Look at that. Kind of did what I thought the Dow was going to do. The SPY went right up to the 200-day moving average. And the Dow, which I think is going to erase all of these gains, went all the way up here, making it look like we're really trading higher. But if you look at momentum levels, they don't lie. And momentum levels are telling us, look at the Dow, look at these momentum levels. I want you to see this with your own eyes. So this is a 20-year chart on the Dow. Look at this. Look at where we're at. There's no way in hell this is going to sustain itself. So last time we saw these levels were 2016. So I think the market is, in fact, going to cool off. If I were you right now, I would be focused on the industrial sector, on the healthcare sector, and the basic materials. These three sectors, and consumer staples. Where's my consumer staples? There it is. These four sectors right here, industrial, healthcare, and materials, and consumer staples. I would wait for energy to stabilize, but I think energy may be a good low-hanging fruit. I'm buying some of these levels, but I'm not going crazy. So let's see what happens next couple of days, and if we get a run-up in energies, which I think we will again. But I think we're going to see a cool-off in the broad market, which may inadvertently pull energies down with it just a bit before it goes higher. I mean, the truth is, energies are still correlated to the rest of the market, and if the Dow and everything else falls down, it may take energies with it. I just gave you guys a fantastic analysis. I hope you guys, please pay me back by putting comments, feedback below this channel. Now, before you guys go, I got something really important for you. Today at 1 p.m. Eastern Time, my good friend Chuck Hughes, he's revealing why and what he's calling the champion indicator. This training is bigger than anything, and I mean that. This is bigger than anything Chuck has done in his nearly 40-year career, because for the first time, he'll be handing regular investors a powerful tool that can signal a lifetime of trading opportunities. Turn off any distractions, grab a pen, grab a paper, and make sure you're free at 1 p.m. Eastern Time. This is going to be historic, folks, because what you're about to discover has predicted 8,141 backtest trade setups since 2002. Oh, yeah, it's like that, with an incredible win rate that he'll break down for you himself. I think it's over 75%. Follow the link below. Check it out. You don't want to miss out. It's going to be a great show. I haven't done anything with Chuck in a while. I don't remember doing anything with him. Anyway, it's been a long year. It's been a long year. Don't ask me. But Chuck is in the house. You guys are going to love it. Follow the link below. This is groundbreaking. This will outpace anything Chuck has done in his 40-year career, and this is a champion trader, champion indicator. You have to attend 1 p.m. Eastern Time. You got to attend. I'll see you guys there. Follow the link below, and if you're watching on the Wealth Press YouTube channel, there's a link in the descriptor. Make sure to like this video, subscribe to this channel, and give me plenty of feedback, and I'll respond to your questions. If you want to reach out to me, support@marketgeeks.com. Bye, guys. Have a great day. Don't miss out. 1 p.m. I'm going live Eastern Time at 1 p.m. with Chuck. It's going to be fun. Bye.